Welcome, everyone. Thank you for tuning in. I assume that you all watch my videos because you get value from them by learning how to accurately read price action and order flow and learn how to execute, right? I specialize in ICT, smart money concepts, and an upcoming trader who is a member in our free Telegram group. Go join the group by clicking the link in the description of this video. They actually asked if I can elaborate more on PD arrays and also SMT divergence. These are some key ICT concepts made easy. So first, PD arrays, also called PDAs. The PD it stands for premium and discount. In a bearish trend or bias, you measure the range of an expansion leg after price runs out external range liquidity lows. Okay, using that Fibonacci tool is how you measure that, and you draw from the high to the low, the highest wick to the lowest wick, and above the 50% fib line are premium prices, which is ideal for selling. Okay, vice versa, in bullish bias or trend, you draw from low to high and the lowest wick to the highest wick, and below the 50% fib line are discount prices, okay, which is ideal for buying. And keep in mind news wicks as well. If it is the lowest or highest wick, you want to draw your Fibonacci on that because the news wicks represent real price delivery by smart money who intentionally uses news to run liquidity. Okay, the news spikes raid liquidity above highs or below lows, which often become key support and resistance areas. If you're ignoring the wick, it's ignoring where smart money likely engineered a stop hunt or trap. Okay, now we're going to go on to the chart and show you a little example of that. Okay, so now we have Euro USD, the weekly chart pulled up, and you can kind of see here. I'm gonna kind of be picky with it. Not really picky, but I'm just gonna kind of choose obvious, swings that I see. So we see right here these swing lows, highs, low, high, low, high, right? So with your Fibonacci tool, you're going to get your Fibonacci tool from right here on the side. You could click right here, fib retracement, and star it, okay? And you really don't need too many levels, but I'll explain all of them within this video and what they mean, okay? So what you're doing is you're taking your fib tool, and in a bearish situation, you are going from the highest wick, and you take that from your point A is going to be your high, and you draw it to where it took out the lowest wick there, which is going to be your point B. Okay. And price above 50%, the zero point 0.5 fib level, and you could change it to percentages and things like that. I have it as like levels with values, but you could change it to percents. So this 50% level right here, anything above it, that is premium price, which is ideal for selling. Okay. And then whenever price creates a new high with the highest wick right here and it takes out the low, you just drag it point A right here to the lowest wick, point B, before the retracement. Boom. And above 50% is ideal for selling. Okay. And again, it takes out this swing low. You just drag it, the highest wick point to the lowest wick point after taking out that low that created a retracement. And see how this one didn't go above 50%. It didn't go into the ideal selling area. It just retraced a little bit, but we'll get into what it retraced into and things like that. Now that's like a bearish example, a selling example. So like in a bullish example, see the swing high right here and how price created the swing low, expanded through that. You take your fib and you just pretty much place it from the lowest wick, boom, up to the highest wick, boom. And look at how it came into discount price. It actually came into the optimal trade entry, which we're also going to talk about in this video. Keep your pants on tight. And you can see from here in discount price, this is the ideal area that we look for buying opportunity. It expanded and it took out that external range high right here. And then from there, you could drag it. Boom, boom. Now, this one didn't necessarily hold. Why didn't it hold is likely probably like a higher time frame situation. But again, what I like to see too, this is external range liquidity. This is external range liquidity. And these are a form of premium discount array, PD arrays, which we're also going to talk about in this video, where we also look for price. This is also a big area where buying opportunity is at, because this is super discounted, right? If you put it into idea like that, from 50% and beyond, this is discount, discount, discount. Holy crap, this is a cheap price. Let me load up. You know what I mean? That's the kind of idea, the logic you want to apply to premium and discount whenever you're applying that Fibonacci, okay? Like right here, too, in this scenario, right? You have this expansion up to this high right here. From this low wick, it expanded up to this high wick right here. And it came down, tapped into the 50%. And 50% is also called equilibrium. Okay. That's another term for it. So equilibrium is what it tapped into. It tapped into a little bit of discount. It also tapped into this down close order block and so on and so forth. We'll get into all of that in this video. So those are some bullish examples of, you know, premium and discount, and how you can apply Fibonacci to your charts to find that premium and discount. Okay. Now, arrays. These are tools smart money uses to deliver price into premium or discount zones. There are fair value gaps, which is an imbalance in price caused by a strong move. Order blocks, which are the last bullish or bearish candle before a large move. It often is used with the fair value gaps for confluence, right? A breaker block, which is a reversal after a run on liquidity, order block candle, if you will. You look for these at market structure shift points. And a mitigation block is a little bit of the opposite. It's also a reversal candle, but it failed to run liquidity. And you look for that at market structure shift points as well. I'll show you examples of them both, and they're both the last down close or the last up close candle in that situation, right? And liquidity pools is another form of array, TD array. This is your external range liquidity, swing highs, swing lows. This is where we drew our Fibonacci off of to see our premium discount, right? And the OTE, which is abbreviated for optimal trade entry. It's an actual Fibonacci based entry zone between the 61.8% and 79% premium or discount zone. That's the OTE. And you want to use this in confluence with other PD arrays that we just spoke about, like those order blocks and fair value gaps. Lastly, it's the Judas swing, or others call it the turtle soup. This is a false move or manipulation that acts as a stop hunt or liquidity run before real direction is revealed. You can see these occur within other PD arrays that we just spoke about, right? And I'm going to show you an example of all that right now. Let's bring up that chart. Okay, so first are fair value gaps, right? If I delete everything off the chart, you can see right here. See, I think fair value gaps are a sequence of three candles. One, two, three. Now, a lot of times price has overlapping candles where, like, you can see between these three candles, the wicks overlap between the first and the third, right? You could kind of like take the second one out of idea and focus on the first and the third, right? So like the wicks of the third one and the first one, they overlap each other. But look in this scenario, the first, second, and third one right here, the wicks don't necessarily overlap. Instead, they create a gap. This is called a fair value gap, okay? And you can see there's another one right here between this candle wick and this candle wick. It's tiny, but it's still a gap. A gap is a gap in the markets, right? That's a fair value gap. There's another fair value gap right here. Very, very, very tiny one. Very, 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 very tiny. It's still a fair value gap, okay? And you want to take that into consideration. Very tiny one. Always take the tiny ones into consideration as well. You also have this fair value gap right here. And you can see how price has tapped into this fair value gap right here, respected it, moved away. Price tapped into this one, respected it, moved away. Look at it, creates another fair value gap right here. Boom, boom. Taps into it, wicks into it, melts away. Those are fair value gaps. That is one of the strongest premium discount array, aka PDA, that you can be making use of. Okay. Next is an order block. Now, the way you want to think of order blocks is if price is moving down, like in this scenario right here, you want to think of up close candles will support price lower. And if price is moving higher, like in this scenario right here, you want to think of down close candles supporting price higher. Okay. And this is what I mean by it. So, right over here, if we zoom in on it, okay, this last up close candle, you draw your order block from the wick to the wick. Okay. You take that whole candle, wick to wick. And as soon as this candle closes below it, it has to close below it. That will confirm that order block. See how price taps into it, wicks into it? On the lower time frame, that's opportunity. And then it sells off. Boom. And then right here, retraces back in. And this is the biggest candle wick right here, right? This is the biggest candle. This last up close candle, that's your order block in this scenario, this bearish order block. The up close candles are bearish order blocks, okay? We close below it with this candle and look at how price retraces, taps into that bearish order block, and then it melts away and it takes out this low right here. Again, right here in this scenario, see this last green up close candle from wick to wick. It doesn't tap it. That's okay. Some of these don't get tapped into. There are other things in this picture. If you erase that, what's in this picture? A fair value gap that gets tapped into instead, right? That's why you want to consider them both. Notice how price wicks into that fair value gap. That is opportunity on the lower time frames. Again, we're looking at the weekly time frame, right? If we have this bearish PD array, we're going to look for sell opportunity on the lower time frames, okay? And this is a fair value gap. Again, these are order blocks, the last up close candle, right? In this scenario. Again, this last up close candle, boom, boom, draw it out. It doesn't tap into it. What does it tap into instead? This fair value gap. Boom. Now, what you can do as well is you can also consider if there's a sequence of up close candles, because like I said, up close candles will support price lower. You can be fluid whenever you start developing this intuition for trading and reading price and everything. This sequence of up close candles, like from here to here, whenever price closes below it, you could use that sequence as a type of bearish order block, because if you look at the higher time frame in that area, that's just one up close candle. That's just one order block candle. Once this candle closes below it, we're on the monthly time frame now, by the way. Look at this one up close candle, price closes below this, and then we tap into that up close candle order block. It's just it's kind of that simple and that easy, if that makes a little bit of sense. But those are bearish examples. So like a bullish example right here, right? It's the last down close candle in this sequence, right? So right here, you have the down close candles here. You have this one. I would take into consideration the one with the lowest wick, because you have this candle, right? And then you have this candle. If we just move this little line over right here, you have this candle, this last down close candle, and this last down close candle. This is a significant one because it's bigger, in my opinion. I would take this one and I would, whenever price closes above it with this candle right here, and this one wicks into it, that's lower time frame opportunity, and it takes off, right? And then right here again, this last candle right here, boom. But it closes above, doesn't come back and taps in, but what can you do? Because like I said, down closed candles, they support price higher. So you could take into consideration this sequence of down closed candles. Price closes above it, this next wick taps into it, that's opportunity on the lower time frame, right? Again, you see this big down closed candle right here. It's the last biggest down closed candle. So I would go with that one right here before the sequence up. You know what I mean? And it price comes back into it way over here in this time, and it moves away from it. You know what I mean? These are just areas of interest, areas where price can find support resistance, right? Excuse me. Now, a mitigation block and a breaker block, right? Those are found at market structure shifting areas. So I'm gonna give you one bearish example right here. So whenever price taps into like a weekly time frame PD array, like this fair value gap right here, you want to go to the lower time frame and you want to look for like a market structure shift opportunity. I'm just gonna kind of like fast forward through it. We're not gonna really like go through it too much. I'll show you that here later in this video. Just keep watching, okay? So swing low, push through, swing low, boom. So this right here, this last up close candle before the movement down, market structure shifting point is like right in this area right here. And you can see price broke that, started creating bearish PDAs. I'll explain all that later in this video, okay? But right here, this last up close candle that took out liquidity before reversing, this is a breaker block. And see how price comes back into it? Not once, not twice, not once, not twice, but 3 freaking times. And after the third time, it melted away from that, right? That is a breaker block. Okay. A mitigation block is in this scenario, let's say that this high right here, this swing high right here was actually higher, right? And then this one right here happened. And it failed to break this high right here. If this failed to break this high, this last up close candle becomes a mitigation block. It's pretty much the same thing. It's just literally did it break the high or no? You know what I mean? That's how you can identify if it's a breaker block or a mitigation block. But it's the last up close candle right before that market structure shift, change in the state of delivery, reversal situation happens. This is a bearish example, right? A bullish example, if we look like right over here, see this bullish fair value gap right here, price wicks into it. We could go to the 4-hour, look for reversal opportunity right there, lower time frame opportunity to get in here, right? So you see how we have this situation where we have this last down close candle because it has the longest wick in comparison to the candle right before it. This last down close candle is, I mean, if you wanted to, you can consider that one too. It doesn't matter in the situation. It is just being more so fluid and understanding the areas of sensitivity. And these are the areas of sensitivity. So go ahead and rewatch this video multiple times and make sure you're taking notes. You guys, this video is a golden video for you to be taking notes on. I'm not going to kid. So right here, this is a breaker block. Okay, this is a bullish breaker block situation right here. This is the last down close candle before the up move, and price doesn't necessarily come back into it. It doesn't look like that whatsoever. Instead, price taps into these fair value gaps right here, and then we also have this fair value gap that's right here, right? That price comes back into right here. And so in this scenario, this is a bullish breaker block. Just keep it in mind. Price can come into it, tap into it. When it taps into it, that's an area of sensitivity. You can look for opportunity. But if it doesn't tap into it, that's okay, dude. Just keep in mind of every other area of sensitivity prices potentially going to tap into. You know what I mean? And so in this situation, again, if this swing was lower right here and this one didn't break this swing low, if this swing did not take out this swing low right here, this is a failed swing low and this would become a mitigation block. Okay, that same down close candle would become a mitigation block. It's just the same situation. Okay, just did it take out the low? Did it do a liquidity grab? Okay, so those are mitigation and breaker blocks. Okay, another form of PD arrays. Now, liquidity pools like external range liquidity are swing highs and swing lows. These are those ones that you draw your Fibonacci off of. You can just see them all over the chart right here. You got right here, especially if they're relative equal lows. Like you can see that there were this one right here, and then there was this low right here that were relative right there. And then this price tapped into it and then moved away. This is a form of a PD array, right? This is where it's like a Judas swing, a manipulation move. This is a turtle soup right here, and it moves away from it. You know what I mean? So you can see them all over the charts. You have this swing high, swing low, swing high, swing low, swing high right here, swing low right here, swing high, swing high. Look at these relative equal lows right here. And of course, price taps into it. Swing low, swing high. You just have like these areas that price like consistently like ends up reaching into. It just like goes into them, and whenever it takes them out, like this area right here, it takes it out, and whenever it takes it out, it eventually moves away, right? And it created new swing lows, and then it moved away. You know what I mean? Took out these highs, and after taking those highs out, it had a retracement, taps into a fair value gap, moves away, takes out those swing highs, retraces. What does it retrace into? This last down close candle sequence, this order block area, moves away, taps into that external range. You know what I mean? External range liquidity are just those swing highs and swing lows. Okay, just pay attention to them, keep them in mind all the time. The OTE, aka that optimal trade entry, is another form of a PD array. Okay, so whenever you have your expansion, right here, you have this low right here. You draw from the low up to the highest wick point right up here, and notice right here you have that right where your equilibrium is in discount. You have that 61.8% to that 79%. This is your optimal trade entry area, and you don't want to use it on its own. You want to stack it on top of other PDAs that we just discussed, specifically a fair value gap or an order block. And you can see in this scenario, we have this down close candle right here, and better yet, you actually have this one right here, the last down close candle right here, and it taps into optimal trade entry right here, then price moves away from that. That's a bullish example of that optimal trade entry. Like a bearish one is right here, for example. You have this external range low, price expands through it. You draw your Fibonacci from that high to that low of that expansion leg before the retracement, taps into that 61% optimal trade entry area. And again, you want to stack it on top. What else did it tap into? It tapped into that last up close candle order block right there, that bearish order block, right? Boom. That is where you find opportunity and it sells off, right? From that area, you sell. Okay, so you find your premium and you find your discount optimal trade entry area right there. Okay, and last but not least is that Judas swing. Okay, that Judas swing, aka that turtle soup. This is that false move manipulation that acts as like a stop hunt and whatnot in those scenarios. So like right here, for example, right, let's go and look for one. So if I delete everything right here, for example, right? If we're like selling off, you see how we have this fair value gap right here. We have this bearish fair value gap that price tapped into before moved away. And then with this wick right here, it came all the way up and it took out these highs right here, tapping into that bearish fair value gap. That is a turtle soup, aka a Judas swing. This is a bearish one right here, right? And another scenario where it happens is right here. See this wick right here? Even the wick, it creates a swing low right here, okay? Three candle wick swing low. I talk about it in my other videos. Go watch them. We're also going to talk about it later in this video, so keep watching. But right here, this three candle wick swing low right here, we turtle soup it. And what are we in right here? We have this fair value gap that we're within right here, right? We have that fair value gap. We turtle soup it, Judas swing. And now this is current price. I anticipate that price can potentially start expanding and take out this swing high right here. And this is the 4 hour time frame on euro dollar. So by the time you watch this video, go see if I was right. We'll see if I was. All right. But this is a turtle soup right here, a Judas swing. This is what I would classify it right on the 4 hour here for euro dollar. Okay. So that's a bearish and a bullish turtle soup situation. Another example of a bullish one is right here, right? You can see we have this fair value gap. Price created this swing low. It went up a little bit and then it melted. Turtle soup took out that swing low right there. Judas swing, turtle soup. What else did it tap into? A deeper fair value gap right here. And if you were to draw your premium and discount, what else is that? It's your optimal trade entry right there. Oh my gosh, that's like three PDAs stacked on top of each other. And what else do you have right there? You also have your down closed candle right here. Holy smokes, you have four PDAs stacked on top of each other right here. You have a turtle soup, Judas swing, PDA that just got ran. You also have a fair value gap. You also have that optimal trade entry, and you have that bullish order block. This is a beautiful buy opportunity in my book. Okay. And you can see it freaking flies from that area. Gone. Okay. Those are PD arrays, and that's kind of how you can take advantage of those. Now, lastly is SMT, which is abbreviated for smart money tool or smart money technique, which is a confirmation tool for spotting divergence between correlated pairs, aka a crack in correlation amongst correlated assets that reveals smart money manipulation where they are buying one market and selling another. This is what the retail crowd doesn't notice. Go ahead and rewatch that little clip again because I know that sounded like a lot. Rewatch it and you'll understand it. I'm telling you. SMT is used to spot true direction and confirmation reversals. Compare two correlated assets like GBP USD and Euro USD or NAS 100 and the S&P 500, and when one pair makes a higher high and the other fails to make that higher high, instead it makes a lower high, that right there is SMT divergence, where smart money, it's likely selling the one that made the higher high liquidity grab. Same for lows, okay? When one pair makes a lower low and the other does not, that is SMT divergence right there, where smart money is likely buying the one that did not break the low. Now, think deep and wonder, why would smart money likely sell the pair that made the higher high, but not buy the pair that made the lower low? Instead, smart money buys the pair that didn't break the low, right? So I'm paraphrasing, but ICT says when one market grabs liquidity and the correlated market doesn't confirm it, the one that did not go for liquidity is usually the one smart money is interested in. The one that did was the trap. Okay. And just a simple rule of thumb is during bullish SMT, buy the stronger pair that did not break and make a lower low. Okay. And during a bearish SMT, you want to sell the pair that did break and make a higher high. Okay. Just a simple rule of thumb. And you want to use SMT to confirm trade entries and to spot traps before they actually happen. Okay. You look for SMT in combination with PDAs like fair value gaps and order blocks. Okay. Premium and discount and liquidity rates. And when price taps into a PDA, that's whenever you check the correlated pair to see if SMT is present. This is just going to give you extra confirmation. It's a powerful confirmation, truly. So we're actually going to bring up the charts again, and I'm going to show you an example of that. So right here, If we're looking at that example, remember that super solid A setup that I said? Look at how much more solid it gets right here. If we look at the swing low that we drew that Fibonacci off of right here, this low right here was March 6th at 13 EST, right? Look at the time down here. March 6th, 13 EST, 4 hour. If we go to GBP USD, which is the correlated asset, look at March 6th, 13, it swept out liquidity. It did a liquidity run. This is smart money technique. Look at how from here to here, it makes a lower low. But if we look at Euro USD, it makes a higher low. So pop quiz, which pair would you want to buy? Would you want to buy Euro USD or GBP USD? Drop your answers in the comments down below and I'll answer your comment, okay? The answer was in this video already, okay? So if you were taking notes and if you were paying attention, you would know. But in this scenario, this is SMT divergence right here. And it just added to this super beautiful setup right here. And it's no wonder why price flew from here. You know what I mean? It's like, holy smokes. Not only was there so many PDAs in the scenario, but it also had smart money technique right here, right? It also has some SMT divergence present, okay? And so it, again, you can see right here with GBP USD, it took out this swing high right here, right? It took out external range liquidity high, right? And this was March 18th at 13 to March 19 at 17. If we go to March 18 at 13, which was right here, let's see, March 18 at 13 to March 19 at 17, which was right here. See how it made this higher high and this one made a lower high? That is a crack in correlation amongst correlated assets, right? And so again, you don't want to just use it on its own, but look at how price taps into this fair value gap right here, and GBP USD is taking out external range liquidity right here. And so in this scenario, again, which one would you want to sell? Drop your answer in the comments down below. I will answer your questions. Again, the answer has already been said in this video. Okay, so that is smart money technique, SMT divergence. Go back on your charts and just look at areas where price tapped into PD arrays like external range liquidity, swing highs and lows, or fair value gaps and order blocks, and go to the correlated asset and see, did it go lower? Did it make a lower low? Did it make a higher high? Like, just look at it and see, was SMT divergence present? Now, I personally don't rely on SMT divergence. It is a powerful confirmation, but I like to keep my trading a lot simpler. You can add this if you want to. Again, we are all our own individual traders, okay? Now, how can you put this all together in a strategy that you can consistently execute? Well, first, I like to begin on my weekly time frame. I like to start with, what is my next drawn liquidity? Is it internal range liquidity or is it external range liquidity? The way I know this is, where is price moving most recently from? Is it moving most recently from internal range liquidity or external range? In the scenario right here, you can see we have this bullish fair value gap right here. Price wicked into it and expanded higher, right? And it created another bullish fair value gap. Price tapped into it, expanded higher, right? And so whenever price is retracing and tapping into these internal range liquidity fair value gaps, my next draw on liquidity becomes that external range liquidity, okay? And whenever it taps into external range liquidity, my next draw on liquidity becomes internal range liquidity. And I prioritize fair value gaps, okay? Fair value gaps are the best bread and butter that you can make, right? It's awesome. And so right here, we're at this swing high where we took out this swing over here. And another thing that I like to, mention is, are we disrespecting old fair value gaps that are bearish ones that price held in the past. So like for example, right here, you can see that price held this bearish fair value gap in the past. And right here, price closed above it, disrespecting it. And not only that, it created a new one. So in my mind, reading order flow, this is reading order flow and what price is doing is disrespecting old PDAs, it's creating new PDAs and respecting new PDAs, and it's expanding through external range liquidity highs, right? And in this scenario, what I'm doing is I am anticipating that from this swing low right here up to the swing high, see how equilibrium is within that fair value gap. I want to anticipate on the weekly time frame, price is going to come into that PDA, hopefully into, equilibrium, into discount, and that's where we will look for opportunity. We will drop to the 4-hour time frame and we will look for a market structure shift. So like for example, right here, I know that this is current price and we don't know what's going to happen just yet. We'll see in the future. But like if we go back to like for example right here, price had this expansion, it's got this external range liquidity, it expanded off of this bullish fair value gap, it's respecting this bullish PDA, and it's disrespecting old bearish PDAs where it closed above this bearish fair value gap. It also closes above this bearish fair value gap right here as well, right? It's disrespecting old bearish fair value gaps and is creating and respecting new bullish fair value gaps. In my mind, I'm like, price is likely bullish. So from this scenario, you could draw your Fibonacci off of this leg from this low up to this high and look within your equilibrium. Is there like a fair value gap? Yes, there is. There is a fair value gap right here. Is there like an order block? Yes, there is. There's this order block right here, right? And you can kind of see how they stacked on top of each other and price moved away from that area. And then you can also wonder, is there potentially some SMT divergence present? Well, we can see from the low here of June 24 to August 5th, June 24 to August 5th, June 24 to August 5th. No, there's no divergence present on this one. But what you can also do is you could add the dollar index, right? And if we go to June 24 to August 5th, where is it? It's going to be in a sell scenario here. June 24 to August 5th. No SMT divergence is present. What we would have wanted to see is this August 5th point to be higher, okay, on dollar index. Now, you can use dollar index if you want to. It's not it's optional. It's not, mandatory like using GBP USD and Euro USD is mandatory in my opinion, but right here. Again, there's no SMT divergence present. Now, if you relied on SMT divergence, you would have missed this setup. That's why I don't like to use SMT divergence in my trading. I keep my trading a lot simpler. Okay. So right here, no SMT divergence present, but we have this in it's tapped into internal range liquidity, it's tapped into discount, optimal trade entry, fair value gap, and bullish order block. I'm going to drop to my 4-hour time frame and I want to look for a 4-hour market structure shift bullish. Now, whenever we're looking for that, we want to first look for the 3 candlewick swing high that was created whenever price initially tapped in. So whenever it initially tapped in, the first 3 candlewick swing high is going to be this high right here. Why is it a 3 candlewick swing high? Because the wick to the left of it is lower and the wick to the right of it is lower than the one it is. The middle wick, right? So the middle wick, left wick, right wick. The middle wick is always the higher one. If it's a lower candle, see how the wick low, low, and this one's bigger, or I should say longer to the downside. That's how you can identify your 3 candlewick swing highs and lows. So this is the 3 candlewick swing high, creates this one, and it creates this one. And what we want to see is we want to see some displacement, some disrespect above it, right? And it creates this one. And notice how price closes above it. But what it didn't do was it didn't close above this bearish order block right here. And I would have wanted to see that close above that bearish order block for me to anticipate more higher prices. Instead, it closed within that bearish order block and it respected that bearish order block. And that's how you get wrecked. You want to see it disrespect those PDAs. So not only are you looking for a market structure shift above that 3 candlewick swing high, you're also looking for it to create displacement that creates like a fair value gap. You also want to see it disrespect the PDAs that it's closing within. This one closed within this bearish order block and it didn't disrespect it. Instead, it respected it and it went even lower. So from there, 3 candlewick swing high is right here. And then we create this one and see how it closes above it. But what is it closing within? This fair value gap right here. You see that fair value gap right there? From this wick right here to this wick right here, that's a gap. It didn't close above it. It didn't disrespect it. It closed within it. It respected it. You know what I mean? It showed bearishness and it moved lower. And then right here, boom. This candle disrespected this fair value gap that held in the past. It disrespected this fair value gap that held right here. And it created this fair value gap, bullish fair value. It disrespected old PDAs. It created a market structure shift. It's beautiful. This is a beautiful setup right here, right? Right here from this low, let's see if divergence is present, right? It's August 8th at 5 up to, let's see, August 9th at 5. August 8th at 5 to August 9th at 5. Okay, right here. August 8th at 5, which is right here, to August 9th at 5. Right here. Nope, no SMT divergence present. They both made these higher low situations right here. And so it's okay. Again, if you depended on SMT, you would have missed out on the opportunity. Know what I'm saying? And so right here, price taps into that bullish fair value gap. That's where you execute and you can go long right there. Okay. Where would you put your stop loss? You would put your stop loss below the low of the one candle of the fair value gap pattern. So see, it's a 1, 2, 3 candle pattern. I'd put my stop loss below the low. And again, if you drew your range, this is also like your dealing range whenever you get that. So your premium discount Fibonacci is just a range to measure your like retracement. Okay. And there's just so many different terms for it. But whenever you get a market structure shift change in the state of delivery, this now becomes your dealing range. I know so many specific terms, bro. I get it. I freaking get it. I know. But see, it doesn't even come into discount. And it just respected this fair value gap. It didn't even come into discount. And price can do that sometimes, dude. You know what I mean? We just got to be fluid with price. I don't necessarily use the Fibonacci and I don't rely on premium and discount. I like to rely on PDAs. Whenever price taps into a PDA, it doesn't matter how deep the retracement is to me. I like to just drop to the lower time frame and see if a market structure shift happens or is present. Now that's a little bit more aggressive. You could be a little bit more conservative and you can, you know, wait for price to tap into your premium and discount so that way it's a little bit more conservative for you and you're not so risky like myself as a trader, you know what I'm saying? But now I kind of want to discuss winning and losing streaks with emotional intelligence in trading, right? Both streaks, they can mess with your psychology in opposite ways, leading to poor decisions, broken discipline, and even blown accounts, okay, if not handled properly. Let's break it down fully. So why winning and losing streaks are inevitable is trading is a game of probabilities, not certainties. Even with the strong strategy like I just presented to you, you'll have losing streaks due to randomness or market conditions, winning streaks when your edge aligns with the market. And what separates pros from amateurs is how they respond to those streaks, not the streaks themselves, okay? How to handle losing streaks like a pro is you want to stay calm and don't panic, you guys. Losses, they are all a part of the game. Even pros lose 40% of the time sometimes. Don't let a few losses lead to emotional decisions. You want to take a breath, recenter, remind yourself this is a long term game, okay? And you want to reduce risk temporarily, cut your risk per trade from 2% to 0.5%, quarter percent. You want to protect your capital, okay? This lets you stay in the game and build confidence without major damage or account drainage and, what is it? Drawdown, account drawdown. Trading small helps lower emotional pressure, okay? And third, you want to stop trading if emotions take over, okay? If you're frustrated, angry, or desperate, just walk away from the charts. Revenge trading is how people blow their accounts. You want to take a break, do a reset, journal, review, meditate, and come back with a little bit more clarity, you guys. And fourth, you want to review your journal and your strategy. Ask yourself every time, am I following my trading plan? Are my losses strategy based or emotion based, right? Is the market behaving differently right now? Ask yourself those things. Good losses are part of the system, and emotional mistakes based losses, they need to be fixed. So you want to track those kind of things. Make sure that you guys are journaling, okay? And fifth, you want to focus on execution, not outcome, okay? Your only job is to execute your edge with discipline. Don't step outside of your edge. Stay disciplined, okay? Winning traders accept losing streaks and they don't let them shake their identity as a trader. Now, how to handle winning streaks without getting cocky. You don't increase risk after wins. A big mistake is traders feel unstoppable and they increase lot sizes. This often leads to a big loss that wipes out many gains. Stick to your predefined risk per trade with no exceptions whatsoever. Second, you want to watch for overconfidence. Overconfidence, it leads to overtrading, forced trades, and ignoring your rules. You want to stay grounded. Wins are part of the edge, not proof that you're market gold, okay? That you're a market god, all right? Mindset shift. You got to shift that mindset. I'm doing my job well, and the market is rewarding my discipline, not my ego. Third, stick to your plan. Winning streaks create temptation to take extra trades or ignore setups. Don't change what is working. Stick to what brought the wins, okay? Withdraw or journal a small win. Taking some profit out of your account, it reminds you that trading is real, not a video game. Journaling a win, it cements what you did right and it builds confidence without arrogance, okay? And you want to maintain a routine and structure. Success can make traders sloppy. You want to continue your pre-trading prep, risk checks, and emotional check-ins. Stay humble because markets, they can humble you in seconds. The right mindset for both streaks is think like a casino. Casinos, they don't panic after a few player wins. They trust the edge over hundreds of bets, and that's you. You are the casino. The edge is your trading system. Detach from outcome, focus on process. Losing streak? Ask yourself, did I follow my plan? Winning streak? Ask yourself, am I staying disciplined? Keep the focus on flawless execution, not on profit and loss. Some tools to manage streaks emotionally is a trading journal. You want to log emotions before, during, and after each trade. Strategy adherence, mistakes, mental triggers, they all help you spot patterns and fix problems early, okay? So journal all of that. Keep a risk management plan as well. Have rules like max 2% per trade or max 1% per trade. Stop trading for the day after taking two or three losses and reduce risk after consecutive losses, okay? and then take a break after 5 straight wins to prevent over trading and, potentially giving that profit back to the markets. Have some mindset reminders. Keep these visible in your workspace where you're trading. Trade the plan, not the outcome. One trade does not define me. Consistent execution equals long-term success. And the market doesn't owe us anything, write that down. The market don't owe me anything, dude. You remind yourself. Some final thoughts about mastering your reactions. It's the ultimate edge. Okay, your trading success isn't defined by streaks, it's defined how you respond to them. Okay, the market, it's going to test your emotions in many different ways. Your job as a trader is to stay grounded, disciplined, and consistent. A key reminder is anyone can make money in a hot streak. Professionals, they keep it by surviving the cold ones. How's that for some game? I hope y'all got some value from this video. I think this video is pretty solid. If y'all got some value, let me know. Drop a like, drop a comment, go join our Telegram group. It is free. Go discuss, go ask questions. I will answer those questions in upcoming videos, you guys. Let's continue to grow the community. Thank you again for watching. If you're new here, subscribe, turn on that bell so you know when we upload. We'll see you in the next video. Bye.